Turkey is in economic turmoil. People are queuing for bread, cutting back on meat, and are even fleeing to other countries. Why inflation, which currently stands at more than 21 according to government statistics. The U.S. inflation rate, by comparison, is at a 39-year high of 6.8, nearly twice as much as a global average of 3.5%. Unlike the U.S., Turkey is an emerging market. It seemed 2 decades of broad economic growth and an expanding middle class, but now the lira is in free fall as the country reckons with President Recep Tayyip Erdogan's unorthodox economic approach, which is contrary to widely accepted inflationary wisdom, as central banks around the world respond to a stronger than expected pickup in inflation amid economic recovery from the pandemic. There are lessons to be learned from Turkey's approach. In a nutshell, to prevent the economy from overheating, central banks can increase the cost of borrowing by raising interest rates, which curbs the rate of inflation. And this is precisely what is happening in most other emerging market central banks to great effect. But Turkey's central bank has done the opposite under pressure from President Erdogan, who has invoked a religious prohibition on usury in his argument against high interest rates. The rate has been cut 3 times since mid-September, which torpedoed the value of the lira. A rapidly weakened currency pushes up the cost of key imports like food and energy. This is already hurting the Turkish people's bank accounts of the Turkish public. Said the government was handling the economy badly. The crisis has prompted protests mostly from union members and calls for Erdogan's government to resign. Turkish banks so far have been able to withstand the currency crisis, but economists are concerned that a further collapse of the lira could trigger a bank run or that Turkey could default on its foreign debts. Erdogan, meanwhile, has said he welcomes the depreciation of the lira to encourage an export-based economy similar to Japan and Taiwan. He and other officials have insisted that the currency fluctuations are temporary. Some economists have said that the strategy is likely to fail because inflation has put pressure on exporters, who now have to pay more for energy and raw materials. Others doubt that Turkey's inflation is even at 21.3%. An independent research group estimates that in reality the figure is more than 58. Investors and economists fear that Turkey's embattled economy could get worse before it gets better.